Hi everyone. Today we're going to talk about trends. Trends are one of the most important concepts in technical analysis. Almost every trading strategy or method is built around how to capture a trend. So when it comes to trends, what kind of strategies and applications are there, and how should we use them? First, let's look at what a trend is. Simply put, it's when the market moves in a specific direction over a period of time. Take a look at this chart. It's the index over the past 5 years. You'll notice two major trends. During that period, the first 2 years were an uptrend, followed by a clear downtrend for about a year. Of course, neither the uptrend nor the downtrend happened all at once. There were a lot of twists and turns along the way. But overall, the direction was steady and moved in one direction. A stock is either in an uptrend or a downtrend. If it's moving sideways, then there's no trend. As we mentioned in the 3 basic assumptions of technical analysis, accepting that markets move in trends is a fundamental principle. Trends exist. There is structure to the market. Now, if we classify trends by time frame, they can be long-term, medium-term, or short-term. But how long is long-term? That depends on who you ask. Generally speaking, anything over 2 years is considered a long-term trend. Here's a chart of the S&P showing a long-term uptrend over the past 12 years. So, what about medium-term trends? Usually, if a price move lasts more than 3 months but less than a year, it's considered medium-term. Anything shorter than 3 months even. Just a few weeks is usually referred to as a short-term trend. Of course, people have different ways of defining this. Now let's look at trend lines. What exactly is a trend line? Every trend is made up of a series of highs and lows, like waves pushing forward. If we connect those highs and lows, we'll often find they align along a line or close to it. That's called a trend line. So what's an uptrend line? It's a line that connects the low points of each pullback during an uptrend. In a downtrend, we connect the high points of each bounce. That forms a downtrend line. What's the purpose of a trend line? Let's pull up a drawing tool. The most important function of a trend line is access strong support or resistance. To put it simply, in an uptrend, the trend line acts as support. In a downtrend, the trend line becomes strong resistance. Check out this chart. The price starts to rise. If we connect to low points, we can draw an uptrend line. Later on, when price pulls back to that trend line, it often finds support that could be a good time to buy. Once the trend shifts downward, every time the price bounces back to the trend line, it faces heavy resistance. That becomes a good opportunity to sell or short. So how do we judge the importance of a trend line? There are 2 factors. First, the longer the trend line has held and the more times it's been tested, the more important it becomes. Say an uptrend line has been tested 7 times, held every time that shows the market agrees it's significant. That trend line will be more important than one that's only been tested twice. Also, if an uptrend linear has held for 6 months, it's definitely more meaningful than one that's only lasted a month. The biggest advantage of using trend lines in trading is as long as the trend line holds. You can keep buying when price pulls back near it, as long as it doesn't break. You can stay in the trade. That's simple and effective. No need to watch the screen all day. But once price breaks below the trend line, you should consider selling because the uptrend may be over. So what counts as a valid trend line breakout? There are 2 common standards. First, if the price breaks above or below the trend line by more than 3%, it's considered a valid breakout. Second, if price stays beyond the trend line more than 3 days, that also confirms a breakout. So one is a price-based rule, the other is time-based. Say your stock dips below the trend line one day, but not by much. Just a small break, not 3%. You can wait and watch for 3 days. If it doesn't recover in that time, you should sell. The uptrend might be over. Of course, this is just a commonly used rule. You can always define your own rules. Let's talk about role reversal with trend lines. Once a trend line is broken, its role can reverse. Support becomes resistance. Resistance can become support. For example, look at this chart. During an uptrend, the trend line acted as support. Then came a breakout day. Price fell through the trend line on the bounce back. Price touched the trend line again, but now it acted as resistance. That's why we say some levels are critical. If price breaks below them, any move back to that level will face heavy selling pressure. Now you may wonder, should we use the closing price, high price, or low price when drawing trend lines? It's rare for all the highs or lows to fall perfectly on a straight line. Often, long upper or lower wicks spoke through the trend line. So what should we use? The close or the wick? Generally speaking, it's better to draw trend lines based on closing prices. Ignore the wicks, in my opinion. That makes the trend line more reliable. Let's talk about the slope of trend lines. Some trend lines are steep, others are more gradual. A steep trend line means price is moving fast. Some uptrends rise at a 60-degree angle. Others, in slow bull markets, move at 30 degrees. Ideally, a 45-degree angle is healthy. Lines that are too steep tend to break easily. So the slope of the trend line tells us how fast price is moving. In a bull market, the speed of the trend changes over time, fast early on, slower in the middle, then speeding up again near the top. Look at this chart. When tracking price, we often need to adjust the trend line as the slope changes. But trend lines also have limitations. When the slope of the move changes, you have to adjust the line. At this point, you might consider using moving averages instead. They auto-adjust and they play a big role in trend reversals. This chart shows the power of the 200-day moving average. In a bull market, it acts as strong support. In a bear market, it becomes strong resistance. This can be a big help for making trading decisions. We'll dive deeper into moving averages in a later video. That's all for this video on trends and trend lines. See you next time.